Welcome to Second Room Studio. Today we're following the money, an additional $3 billion through MAS Equity Market Development Programme or EQDP into Singapore equity funds and a new $30 million value unlock package to help listed companies sharpen how they show up to investors. The question is, will any of that money ever reach your stock? And why would an investor choose you over the next name on the list? To unpack how investors think, I'm joined by Wilson Ng, my friend, veteran research analyst and former head of ASEAN Real Estate Research. Wilson was also the Singapore equity strategist at Morgan Stanley. Wilson, take us through the developments.
Right, thank you for having me here, Grace. So, along with the various market reforms coming through for Singapore, the EQDP is, I think, the single most important thing that's happening to Singapore stock market right now. So, I'm very happy to have this conversation with you. And I think it's very relevant to everyone who's watching this space in Singapore equities. So, EQDP is, and along with the other market reforms, really started as part of an overall government campaign since about a year ago, unprecedented campaign from the government to try to boost Singapore's stock market or equity market. The reason behind that is really, I think, as you know, Singapore has successfully established itself as a global financial hub. We have a very strong commodities market, a strong private wealth market, banking market, and even a number one startup ecosystem here in Asia. However, the missing piece really has been a vibrant equities market, which Singapore still currently lacks. For a lot of the tech startups that we have homegrown and successfully cultivated, so far, I think most of them have been exiting and listing in overseas market as opposed to domestically here in Singapore. And that is quite a pity because if you think about all the effort that's gone in to build up this ecosystem, how can we better retain the jobs, retain the capital, retain the talent here in Singapore and try to drive the economy in a more sustainable way? And one way is to have a vibrant equities market, which is what I think the regulators are trying to fix right now. So what are the measures that are coming through for this campaign? There are actually quite a few measures that have already been announced. So you would have heard about channeling family office money parked here in Singapore into the Singapore domestic stock market. There have been announced tax breaks for stocks looking to list in Singapore, tax breaks even for fund managers looking to invest in Singapore stocks, subsidies for investor relations, subsidies for research coverage of local stocks, etc. And in the center of all this, and I think the one that's really caught the market's attention is the EQDP program. EQDP standing for Equities Market Development Programme. And this is basically MAS, Monetary Authority of Singapore, investing 5 billion Singapore dollars, putting it with active fund managers and telling these fund managers, hey, go out and hunt for Singapore stocks, go and buy some Singapore stocks. And the idea behind this is, as you get capital flows into the Singapore stock market, that will help to drive up trading liquidity. Presumably, that will help to drive up valuation multiples as well. And hopefully, that will make Singapore a more attractive listing venue for new startups, many of which are homegrown.
So with this liquidity injected into the market, my takeaway is that companies really need to step up their game to tell their story. And I often hear leaders saying that, numbers speak for themselves. So I just need to deliver my performance. But the truth is stocks really don't re-rate just based on your figures, right?
Yeah, absolutely. And don't forget, $5 billion is actually not a small sum. To put it in context, we have about $20 billion Singapore dollars that is invested into Singapore equities through Singapore-focused funds. An additional $5 billion can really move the needle. And right now, although the current measures are more targeted at the small to mid-cap space, but I would also say that there'll definitely be, and actually there definitely has been, positive spillovers to the existing large cap space as well, your traditional blue chips that will benefit from both a passive and active flows positioning for these positive changes to the market. But back to your question, at the end of the day, you're right. Investors don't just look at reported earnings. They ask, which set of earnings should I believe in? Which set of earnings should I react to? Which one matters, right? And that's where engagement really makes all the difference. So one of the companies that I used to cover used to report several different measures of earnings. There was net profit after minority interest, before tax, after tax, adjusted EBITDA, non-adjusted EBITDA. And really, somebody has to explain what all these different measures of earnings really mean. Why are the adjustments being made before investors can really take that piece of information seriously and can make it a useful piece of information in their investment decision. If important parts of the story are missed, then unfortunately companies tend to get overlooked, and overlooked companies with lower investor interest tend to result in lower valuation multiples as well. And that's when some of them unfortunately get stuck as value traps. So very attractive valuation numbers, but just really struggling to re-rate upwards.
So, I've been with the real estate sector for a long time. The way I would put it is that, EQDP is putting more serious shoppers into the mall, but it doesn't guarantee anyone walks into your store. So when somebody actually does walk in, you need your products to be lined up, you need your marketing done. So how do you actually stand out?
That's a good question. I like your analogy. So, I mean, the way I think about it is like hidden gems that we're trying to uncover. And to your point, it could be like a hidden store in a mall that's actually very interesting that shoppers need to go and find. So, how to stand out? I think it goes beyond just the fundamentals. So, for good companies, good stocks to be selected, good fundamentals are a must. You need to have good earnings growth outlook. That's fine. But having that actually alone is not enough. From an investment community perspective, after assessing that the fundamentals are sound, investors still further screen for at least another 3 filters before actually making the decision and pulling the trigger to say, okay, let's buy this stock. For the 3 different filters, the first would be number 1, can I own this stock at size? Number 2, can I explain the narrative to the investment committee? And number 3, can I trust management? If you fail any one of these, essentially you fail all. And that's why it's very important to look beyond just the fundamentals. So on the first point, can I own this at size? It's really about trading liquidity and not really so much a judgment, but it's really a test of feasibility. So trading liquidity essentially is like how many dollars of the stock trades is bought and sold on the market per day. And it's actually one of the first screening criteria that institutional investors look at to even consider if a stock is worth investing in. And the reason behind this is for big institutional investors and fund managers, the ticket size per stock can be easily millions of dollars. And if there's a good company that they found, but the stock only trades, say, $100,000 a day, then it's just really not feasible for the fund to be building up that position over weeks or even months. Maybe there's an exception if there's a secondary equity placement where the investor is able to buy it bulk. But even then, at some point, the fund manager would have to exit that position and take profit and cash out at some point. So again, then if there's no trading liquidity, it might take weeks to months to exit that one position, which is just not the most feasible. But how much trading liquidity is enough, right? So talking to the various institutional fund managers, several I've spoken to are looking for stocks that trade at least $10 million a day. And that would pretty much exclude more than 90% of the Singapore stocks.
Yeah.
So it is not the easiest metric to try to achieve. However, there would be some funds that are able to invest in stocks that are a little bit less liquid, but generally higher is better. The more trading liquidity your stock has, then you'll be opening up your stock to a larger pool of potential investors. The second key criteria would be, well, can I easily explain this stock and the narrative to my investment committee, maybe in simple 3 slides? So a lot of companies I've spoken to, and I'm sure it's the same for you as well, Grace, are very happy to share technical information, operational information, which makes perfect sense to somebody working in the company for years, but maybe would be seen as technical jargon for your average generalist investor or an analyst that really may not be familiar with that company or even that familiar with that industry. For example, a company may report, say, some changes to their order book, but what does that mean for investors when it comes to earnings and share price? And same for anything positive the company is doing at operations level, whether it's a refinance loan, a new investment, a new divestment. What does that really mean for earnings? What does it mean for share price? Somebody needs to do that translation, be it the company itself.
How that actually translate and tie to the strategy that they've communicated, right?
Exactly right. If not, these numbers would just be meaningless technical jargon, right? So you need somebody from the company or as a middleman research analyst to try to translate that to a point. That will help to investors to better appreciate why the company is doing these things.
And a broader vision.
Absolutely. So overall, being a good company, definitely a prerequisite for investors to come in and own your stock. But being good at what you do operationally, that alone may not be enough. Maybe you secured a good contract, you bought raw materials at a good price, you manage your cost structure well, or you have a brand new transformative strategy. All these will be great for your future reported earnings. But will investors even know?
Yeah.
Or even if they do know, will they correctly understand and interpret what you're trying to communicate, right? So for a good company to be a good stock, and these two things are different, right? Good companies may not be good stocks. Articulating how the company is good is as important as executing well operationally. The third filter, just to round off, is can I trust management? So with sufficient liquidity and frequent communications, the last screen is whether or not we can still trust what the company says. What's important besides the quantity of engagement with investors is really the quality as well. For example, does the company actually deliver on things that the CEO promises to deliver? Does the CEO answer questions or evades questions? Or is the CEO even accessible in the first place?
Do you have examples of that?
So I do know of a certain, without naming names, certain C-suite in Singapore that is quite known in the investor community for evading questions. And the perception from investors which I've spoken with, this company unfortunately had been very negative just because of that reason. So some of these investors, they actively try to avoid that stock and even avoid taking meetings with this particular C-suite, which was rather unfortunate because the company itself was actually a pretty good company. It's just that they weren't able to articulate their strengths as well. So really transparency and honesty can make all the difference here. And this is especially true when it comes to sharing bad news. So I can think of a positive example actually. Two particular CEOs, which I had the good privilege of working with years ago within the real estate space, were seen as the best CEOs according to most of the investors I spoke with, the institutional investors. And really, these two CEOs, they were not the most optimistic when they were sharing their outlook of earnings. In fact, it's quite the opposite. They were seen as quite pessimistic, but they were also seen as being very realistic. They were pretty brutally honest about how things may not be going that well for the coming quarter or so. And things really turned out exactly as they had shared. So they were being very honest. But this really paid off when it came to the occasion where they had the opportunity to share good news, because that's when investors actually really believed them, because they knew that these management personnel were being very honest. And so they didn't have to discount what they say to the same extent as they do for other companies. So being honest really does pay off.
You can see this CEO is really building trust over time and being very sincere with the relationship and taking investors as partners.
Absolutely. One of them, he's already left his job for more than 10 years and he's still being talked about in the investor community today. So it's something investors really do appreciate. So overall, I would say, to answer your question, the key three filters beyond the fundamentals would be: number one, can I own this in size? Number two, can I explain this narrative to the investment committee simply? And number three, can I trust management? And you have to pass all these three layers. If not, it's just going to be very hard for institutional investors to take a meaningful position in your stock, no matter how good the fundamentals are.
So my takeaway from what you've shared, Wilson, is that the presence of EQDP actually raises the bar. We have now more liquidity, but it's no longer just enough to be a good company. You have to be a good company that is also investable to take advantage of this. You need to be clear, accessible, and liquid enough for serious money. In addition to the EQDP, there is also the landmark partnership between SGX and Nasdaq for dual listings. From your vantage point, how might that change the way global investors look at stocks over here?
Historically, many big regional names, they choose other larger, more liquid equity markets like Hong Kong or Nasdaq for their listings, and Singapore, unfortunately, has been missing out. And this new bridge really raises the ceiling, making it easier to attract US sector-style growth specialists and sector specialists, and really helps better position Singapore as a hub for equities and not just a domestic market. There will be a global listing board introduced for companies with a market cap of more than 2 billion Singapore dollars. And what this means is that companies here are able to tap a larger pool of capital to fund their growth. And this is generally, I think, positive for valuation multiples. Also, hopefully, will help to attract more new listings and inject more vibrancy into the market and inject more breadth and more depth into the Singapore market. So alongside the EQDP, I think one of the recent measures that was announced from MAS was the Value Unlock Program, which I think set aside some money for investor relations, right?
So on the demand side, there is more capital, more pathways. And on the supply side, regulators are telling you that they are funding companies to professionalize through the Value Unlock Program. I think this is a generous 30 million, where companies can now be trained in IR, corporate strategy, comms, and financial management through Equip, which is a 15,000 training grant per company. It co-funds the training and capability building in the areas I've mentioned. And there's also the Elevate Fund, which is 200,000, where you can actually look into professional services. However, there will be obviously expectations for you to publish your plans, set targets, and update the market on your progress. And my view is that the regulators have finally identified the right problem. We mentioned earlier that we have a lot of good companies, but we're just not telling our stories. So in addition to really expanding the pie for the Singapore market, they are there to teach us how to grab our share of the pie. You know, I've been in IR for 15, 16 years. And me and my peers, it's so common that we will be saying that, hey, nobody ever taught us how to do our job, right? So many of us either came from the media, we came from finance, we came from everywhere. So I think it is really high time to really put up a framework for IR professionals, because this is not just a job or department. IR responsibilities are carried all the way from finance folks to the board of directors. So everybody has a responsibility to tell the story of the company.
How would that look like to use that money strategically? What would be a good way to be using it?
I think there are three things I can think of. The first one is, I think the market is always looking for, what's your 3 to 5 year strategy? And it has to be tied to capital allocation. So how much resources is going to be invested in which areas of growth, and what are the expected returns? And even better, if it can be tied to KPIs.
That's absolutely right. I mean, when it comes to KPIs, if you think about the companies that are very well regarded by investors, DBS has their ROE target, Goodman Group in Australia has their EPS growth target. And I think with the market reforms going through in Japan and Korea, the companies there are also explicitly trying to raise their price to book ratios.
And one thing I think we can do better is also tying your KPIs to remuneration. I think if you look at markets like the UK, Australia, I think they do a better job in their annual disclosures, really tying their long-term targets, short-term targets to the bonuses of their C-suites. And I think that is a very useful way to really show your investors how sincere you are, and the trajectory and the roadmap that you have in reaching your goals. And maybe the third one, I would say, the reason for a value unlock is that we do need a regular rhythm of earnings calls, investor days, site visits, and this is really the engagement where management actually shows up. Don't you agree, Wilson?
Yeah, management showing up is absolutely important. In fact, it might be even a criteria for both sell-side research analysts as well as potential investors to even think about investing in the stock. That's part of the due diligence. They have to actually have a meeting with, if not the CEO, then at least one of the C-suites, in order to give them that assurance and security that this is an investment worth looking at.
So on that note, I also want to bring up a very interesting survey conducted by the Stewardship Asia Center by Temasek Trust. It was just launched recently, and it's titled Stewarding Value, Unlocking Market Potential Through Engagement. And there were many insightful nuggets, and I would just like to share some of them. So firstly, what caught my attention was that 80% of corporates engage key investors at least once a quarter. So that tells me that if you're not doing that, you are the minority. And then it's linked to the second point, which I will highlight. 9 in 10 investors and corporates say that engagement's quality has a significant impact on valuation. And if such a high percentage are thinking so, why are you not engaging more? And of course, these 2 points would also tie to the quality of the conversations which you mentioned earlier. And to round this off, more than 80% of respondents say that companies are only somewhat transparent. So I really think there's quite a bit of work there. So I've been speaking to institutional investors, including those who have been given the EQDP mandates. As part of the usual culture of investing here, they usually start with the known names, the blue chips, the SDI index, the banks, property REITs. We have Singtel, we have Singapore Airlines. So mainly large caps company with visible stories. And then, of course, the managers will look for growth potential. They look for catalysts. They look for fundamentals that we talked about earlier. But also importantly, they are looking for clarity of strategy. And they need comfort with the management information flow. But without engagement, this too will not happen. So that also means if you are a smaller listed company, you really need to take advantage and see the opportunity of this value unlock and put yourself on the radar of investors through engaging them. Thank you, Wilson, for being here.
It's been my pleasure. It's been fun. Thank you, Grace.
So if you like the episode, please like, share, and subscribe to Second Room Studio.